This is when gold is supposed to do well. And it says, in a crisis, gold rising sharply is a loss of confidence in fiat. Instead of gold failed, I would say gold was prevented from signaling stress properly, right? And in other words, the selling, the MOPE, as Jim Sinclair called it, management of perception economics, it wasn't allowed to signal things properly. It said it's just a crowded trade unwinding. And I would say, yeah, but who creates the unwind? Who's creating the unwind? Why is it that, you know, they frame this as it's an overcrowded trade unwinding and ignore the massive selling on paper by the big banks? They talk about a highly leveraged futures market, thin margin requirements, large concentrated players.
Gold's failure as a safe haven is frequently cited as evidence that it is no longer a trustworthy store of value. Critics contend that this story is deceptive and a component of what they refer to as management of perception economics, in which market signals are manipulated to preserve trust in the fiat monetary system rather than accurately reflecting the state of the economy. At the same time, governments are under tremendous financial strain due to enormous monthly deficits and looming trillions in debt refinancing. In this context, some analysts contend that artificial selling on paper gold markets is being utilized to manipulate prices, giving the impression of weakness even while actual demand is still high. Supporters of this view point to physical delivery data as the key signal. In recent months, millions of ounces of gold and silver have reportedly been moved out of exchange inventories even as prices fell, suggesting that buyers are taking advantage of lower prices to secure physical metal.
Even the Bank of International Settlements came out and said, this is structural. This is not fundamental. It's structural in the respect that they said it is an increase in the massive amount of levered ETFs that had to reset in January. They had to rebalance because December, the price was up. They had to rebalance. And then margin increases, up. Everyone got squeezed like a grape. And they did. And so the leverage has disappeared to the point where Ed Steer, your buddy Ed Steer, great guy, is saying that it's the lowest short position that the commercial banks have ever had by a long margin in silver, ever. So could it be that they knock the hell out of it to get on sides, to increase their long position? You know, the Economic Times said they're net long a while ago. That could be 11 long, 10 short. They're still short a lot, but net long. Well, are they getting more and more and more and more long? I would argue they are. And so, you know, I think you need to kind of look at these things with a little bit of, I don't know, you have to look at things, maybe not, you have to think outside the box. We can talk about things that are happening, again, that will massively change things. You know, India, as of, April 1st, has mandated that gold and silver ETFs switch from the London benchmark to domestic Indian exchanges as of April 1st, because it's a loss of confidence. They don't trust the Western benchmark price. Well, that's the same exact thing that we see happening, I think, around the globe, a loss of trust. And I do believe here in the U.S. that the big banks have covered a huge position, a portion of their shorts. Open interest is incredibly low. There's been a lot of silver and gold that have been leaving the exchanges. These are, I think, when you have open interest as low as it is right now, that basically means that you don't have the managed money willing to take the other side of all of these trades, these short positions that the banks are putting on. And when you have low open interest, that means that you have the ability for the price to really slingshot when demand jumps into it. So look, all I can tell you is that all is not as it seems. Price is a tool of misdirection. And as the price has been hit, we're seeing so much in the way of deliveries here in the United States on COMEX, a lot of it leaving. 2 million ounces left the COMEX vaults on Friday. Just buy, see you later. You know, the numbers of offloads or loadouts, as they're called, where metal is leaving COMEX is getting bigger and bigger and bigger. Once it leaves, where's it going? It's never coming back, ever coming back. And this is an important thing to think about. It's one thing to see lots of deliveries. We are seeing lots of deliveries. It's another thing to see lots of metal leave the COMEX ecosystem. It is never coming back. And this, to me, at the same time China is loading up, at the same time India is moving benchmarks away from the West. These are all things that I think are really, really important to understand. Metal leaving the ETFs, yet at the same time, the exact same amount leaving the COMEX. Is it filling a void so that it doesn't look as bad as it really is? I don't know. I mean, it certainly is interesting when you see the exact same amounts match up. When you see 1,253,200 ounces of gold be delivered here in March, and 43,565,000 ounces of silver, and the week or the month isn't over yet. These are all things that people need to understand. And this is why there is an entire theory of investing called wave theory. Kondratiev wave, Elliott wave, where it measures the cumulative emotions of the herd. 2 million ounces of silver leave on Friday, just load it out. There it goes, bye-bye. But that, according to Ed Steer, 102 million ounces of silver in January and February combined, plus 26,716,000 ounces of gold were loaded out.
More people are starting to see the 2026 price suppression of gold and silver as a purposeful financial control tool rather than a result of actual market factors. A deeper conflict between paper-based pricing systems and the growing demand for actual precious metals is developing behind the surface narrative of stable markets and restrained inflation. The president of Miles Franklin and a prominent figure in the monetary metals industry, Andy Schectman, contends that this discrepancy is not coincidental, but rather a component of a larger framework known as management of perception economics, in which sentiment and pricing are carefully manipulated to preserve trust in the fiat system. The underlying data presents a totally different picture than the conventional commentary, which concentrates on short-term price fluctuations and speculative liquidations in futures markets. Due to tighter vault inventories and long-term holders gradually removing supplies from circulation, physical deliveries on key exchanges have continued to increase. Now let's hear what he's about to say.
And, you know, I would say to you that it's a lot worse than that, as far as I'm concerned. You know, you look at the federal government, let's just call them Washington. They have no spending discipline, you know, and the market should understand they can create credit out of thin air. And so far this year, we've taken in $2.1 trillion in revenue, but we've spent $3.1 trillion already. It's burning through $200 billion a month before the real war even showed up. And if you believe the official war estimates, you know, maybe I have a bridge to sell you, because I was reading just the other day that the Iraq war was supposed to cost $50 billion and cost $5 trillion. It's not bad forecasting. It's deliberate deception followed by monetary debasement and fiscal irresponsibility. You got the IEA calling this the greatest oil disruption in history. Higher oil prices don't again mean higher inflation, which typically means higher interest rates. Neither one is good for a debt-heavy country that has to roll $10 trillion worth of treasuries. And it's funny. I have this, I actually wrote this down, not knowing that you would talk about it, but might have to put my glasses on to see it. Let me see, because I read an article in the Wall Street Journal and it bothered me. It talked about the mainstream was basically saying that gold failed as a safe haven. And it says, you know, this is when gold is supposed to do well. And it says, in a crisis, gold rising sharply is a loss of confidence in fiat. You know, instead of gold failed, I would say gold was prevented from signaling stress properly, right? And in other words, the selling, the MOPE, as Jim Sinclair called it, management of perception economics. It wasn't allowed to signal things properly. It said it's just a crowded trade unwinding. And I would say, yeah, but who creates the unwind? Who's creating the unwind? Why is it that, they frame this as it's an overcrowded trade unwinding and ignore the massive selling on paper by the big banks? They talk about a highly leveraged futures market, thin margin requirements, large concentrated players, and that structure allows rapid price movements disconnected from physical flows. And I would say the crowded trade is the excuse, leverage is the tool. I mean, I went through all of this to try to figure it out point by point. They said that dollar strength and real yields explain it. That the relationships are inconsistent, and gold falls even when the dollar fell, and gold rose for a year without rising real yields. And I'd say those correlations are used when convenient. Again, we talked about that, ignored when they break. Margin calls, it's just liquidation. I would say, yes, there are margin calls and there are liquidations, but that's totally not the full story. You have the paper market allows mass selling without physical constraint, which we see. And the ETFs and futures create synthetic supply. All of this stuff is ignored. And so I guess it's managing the perception. And the Wall Street Journal wants to point to all of these negatives. But at the same time, let me just take a look at the numbers here real quick in terms of what has been delivered here so far. And we're seeing massive, by the way, in China, in the first 2 months of this year, by the way, they've had record, let's see if I can find the exact number. I'm sorry, I'm not completely prepared here. But so far in the month of March, we've seen 12,532 gold contracts delivered and 8,713 silver contracts delivered. So that's 1,253,200 ounces of gold delivered as the price is getting clobbered, and 8,713 silver contracts times 5,000, that's 43,565,000 ounces of silver getting delivered, literally, as the price is getting clobbered.
Andy Schectman explains that the recent movements in gold and silver markets are not just random price swings, but signs of deeper structural stress in the financial system. He references comments from the Bank for International Settlements, which suggested that what is happening in the market is structural rather than just temporary or based on normal supply and demand. In simple terms, this means the system itself is under pressure, especially because of heavy leverage in financial products like ETFs and derivatives that had to be adjusted and rebalanced. Schectman argues that this kind of leverage washout has left commercial banks in an unusual position, with some analysts suggesting that short positions in silver are now at historically low levels. This raises an important question, whether large institutions may be repositioning and quietly shifting from being heavily short to more neutral or even net long exposure. If that is true, then recent price weakness may not reflect true demand, but rather a controlled repositioning phase in the market. Another key point he raises is the idea that low open interest in futures markets could lead to a sharp price move if new buying pressure enters the system. With fewer participants willing to take the opposite side of trades, even a small increase in demand could trigger a strong upward slingshot effect in prices. In his view, this creates conditions where the market looks calm on the surface, but is actually becoming more fragile underneath. Thank you for watching, and see you in the next video.